Can central banks actually get inflation to 2%? Karen Karniol-Tambour, co-CIO of sustainability at Bridgewater Associates, she joins us now, and she's one of Bridgewater's foremost experts on macroeconomics and FX markets. Karen, the way Mohamed Al-Arian was talking about it, this was a seminal moment. This is a huge game changer for the ECB and then for central banks. And I'm wondering if you believe that we can actually get to 2% inflation.
Hi, great to be here. I don't think with the amount of tightening that is currently priced in, we can get to 2% inflation. And so markets are starting to process the tightening is going to be necessary. Europe is finally getting, the same type of market action that we got in the United States as the Fed was tightening, which is all assets are falling. Bonds and stocks fall at the same time. You don't get any diversification across the two of them because inflation and the need to tighten is the driver. And when that happens, you are trying to slow what is a very strong economy to cool inflation. But if you look at actually the amount of tightening that is currently expected, it's still not that significant relative to the strength in economies, relative to the self-sustaining momentum in inflation. So will it slow the economy? Yes. But will it be sufficient to get central banks back to their goal? No.
Karen, isn't this the compromise we're going to have to live with, though? Nobody wants a recession. Nobody wants a significant slowdown that probably would be required to get inflation back to target. So we accept inflation in the 3 to 4% range, but we don't get the aggressive recession that would come with 2%. Isn't that the compromise we're now dealing with?
I think you're exactly right, Guy. This is why it's really not easy to be in the shoes of policymakers right now. They're going to have to choose whether to make that trade-off, and it's really not an easy trade-off to make because you don't want to let inflation get out of control, and at the same time, it is painful to have the economy slow because of tightening. And it's especially painful if you're Europe, and part of the reason you're getting inflation are things like energy and food prices that you don't produce. And so it's this inflation that's particularly painful, and you have to slow your economy if you literally just can't get enough energy to power it. And so we know from the 70s that central banks faced in that situation really prefer not to over tighten because it's painful. And the more it's external, the more it's geopolitical, the more you're not the producer making money from the inflation, the more painful it is. But we also know from the 70s that they can be behind for many, many years and it can get out of control. I think reasonable policymakers are going to disagree about what to do here, but the risk is that they fall behind and they're so scared to crack the economy, which is right now at such strong levels that they just go too slow.
So, Karen, when you take a look at what happened to spreads, we talked about this a bit earlier with Maria, that the game-changing moment really happened when she's like, we don't have a plan for spreads yet, but we're going to work on it, kind of thing. Is there any plan that they can do to help tampen down spreads that would, in essence, then help support the economy in different countries while also being able to tackle that 2% inflation?
I believe there's a tremendous amount the ECB can do. They've already shown us time and time again that if they think this is important, there is a lot they can do to handle periphery spreads. The main thing when I look at the market action is, look what's happened to credit spreads globally. It makes sense for all risky assets to be selling off into this environment. This is just a tougher environment. And so I'm not sure if I were the ECB that I'd be jumping ahead and making lots of plans for spreads just because the market moves so far. I'm sure they have many plans in their back pocket and they can control it if it gets out of control.
I read Greg's piece in the FT talking about how you guys are positioning around all of this. Karen, in the kind of environment of 3 to 4% inflation and slower growth, how do you navigate it? Just kind of walk me through what you think the building blocks of a portfolio in that kind of environment look like.
Well, the challenging thing in that environment is that most of their risk is in beta and being long assets and holding assets and hoping to make a risk premium. And most risky assets, frankly, look terrible in the near term. So yes, over time, you believe that holding bonds, holding stocks, holding credit spreads, you will make a risk premium. But in an environment of rising inflation and a need to tighten into that, you get terrible performance sort of across the board. And so one consideration is how much can you move towards more tactical positioning, alpha, actually make money off of shorts. And the other big consideration, if you have to hold assets, is how much inflation protection can you get? If you're holding stocks and bonds and you've gotten used to the ideas that they're really diversifying, that's because growth was the dominant issue. And every time growth fell, bonds could do well and vice versa. And today that's not the case. And so inflation protection is really what most investors are missing. And adding that in at least helps the circumstances. But this is just a bad environment for risky assets. And that's the reality for most investors.
where might a central bank put be? I feel like we know it's not in the equity market. Is it in the bond market? Is it going to be in the private market? I'm trying to get a sense of like where the biggest financial risk is that like the Fed and the ECB are going to have to then respond to.
I think if you're the Fed and the ECB, you would not be that worried today about a peak in financial assets. Financial assets have outperformed the real economy for a decade plus. That's been engineered. That's how it's been working. That's been the desire. And now I think it's completely within their desires to have financial assets underperform the real economy to a material extent. And you're seeing that, for example, as tech has cracked, as crypto has cracked, there's been an understanding that this is not that significant. This is not a significant risk for the Fed yet. They need to slow the economy to a degree, and it's healthy for it to start in areas where there were bubbles of overvaluation and pockets where a lot of money went when a lot of money was printed. And so it's pretty healthy for financial assets to do very poorly relative to the real economy for some time now in this environment. It's painful for investors, though, because we've just lived with a decade plus where constantly financial assets did significantly better than the economy. So an investor could do great even as the economy was kind of mediocre at times.
Okay, so let's just come back to what I want to own at this point. You talk about the underrepresentation of inflation-based products in most people's portfolios. Commodity funds have come up a long way already, Karen. Are they going to go further? Linkers have done relatively well. TIPS have done relatively well. Are they going to continue to outperform? When I look at the inflation options that I have, what still looks like good value within that basket?
You're right. It's not great because what's happening in commodities is you do have inflation protection, but you also have significant idiosyncratic risk in every commodity that you hold, especially oil. You know, small changes in geopolitics can make a big difference. And obviously growth matters a lot. And so, for example, in any commodity that's not oil, China is a huge part of the demand. And you can only imagine how much Chinese demand has slowed because of the zero COVID policy. And so commodities don't look nearly as well as they did when you just looked at generally high nominal growth, high real growth and high inflation. Once you kind of have high inflation but weakening real growth, commodities don't look as attractive as they did a few months ago. And while it still holds some, not nearly as good as it was a few months ago. And then same with linkers. I think you're in a situation where if you have to hold bonds, I would completely pick linkers over a nominal bond if I had that choice. If I had to hold a bond, I'd rather just get paid whatever CPI is and just receive it. And, you know, if it comes up above expectations, it's not expected to be that high. I mean, you asked at the beginning, how likely is that inflation goes back to 2? Linkers are basically pricing that they'll go back to, you know, something like 2, 2.5. So I want to get paid anything they are above that. If I have to hold a bond, I'd rather change it to a linker rather than hold a regular bond.
Karen, to that point, we got a question from a viewer, and this kind of ties into what Guy was just asking. What are your thoughts on emerging markets? If you have developed markets, central banks are really in kind of a bind. What about the higher yielding EMs?
I really like some of the stock markets, especially because you're in this situation where just so much outperformance has been priced into the United States. And so you're already expecting that U.S. companies will keep taking market share from everyone for another decade to come. It's pretty hard to do that decade after decade after decade, and it means it's already in the pricing. Whereas a lot of the pricing in the emerging markets is frankly pretty terrible. And the other piece is that we just lived through this period where people had so much money, right? Consumers all got literally checks to their homes. So you saw a lot of money being printed going into many assets, and it actually didn't go into emerging markets. Typically, those are really popular risky assets when you have these boom periods. And instead, it went, you know, to crypto, to tech. So emerging markets are not nearly as vulnerable as they typically are in this part of the cycle where money's starting to come out. Now, that doesn't mean they're not vulnerable at all, but as I said, they're not great options today. Some of the emerging market equity markets certainly look more attractive to me than being in the U.S., which is already priced to perfection.
Just in terms of what you do want to be in right now, you talked about being short. What do I want to be short of, Karen?
Well, I still do not like nominal bonds very much. Okay. And increasingly, I don't like U.S. stocks very much because if you basically look at how much U.S. stocks have fallen, and you say a stock is just a series of cash flows discounted back to today. Yep. You can attribute the entire decline in stocks just to higher bond yields, just a higher discount rate back to today. Actually, almost nothing has been priced in terms of a slowing in the economy, actually fewer cash flows rather than just a higher discount rate. Almost none of that's been priced. And if you look at the Fed raising rates at the rate that it is, and now the ECB raising rates, if you look at how much asset prices have fallen, it does not look very likely to me that you're not going to get a slowdown in the cash flows that companies are getting. In addition to that, you go back to the 70s and you had a very significant rise in risk premiums. Investors didn't want to hold stocks because you were in a situation that was just trickier to manage the economy because inflation was so volatile. That could happen today too. So I think the decline in stocks can confuse people, and it might be hard to not see with the naked eye that all that's happened is slightly higher rates. A lot more could get priced into US stocks in terms of an actually weaker economic outcome and volatile inflation.
Which is kind of what you were talking about before, that like we could engineer an economy that's okay, a softish landing in the economy and then a hard landing within the markets. Just before you go, and this goes back to that FT piece also, what part of corporate credit is more vulnerable if cash flows are vulnerable and yields are rising?
Well, I think if you're looking at individual companies, you have to basically ask, what is the chance that they can flow through the inflation that's coming back to their customers? And so probably the best case study of this is you look back at the 1970s, and there's huge differences between companies, whether they were actually able to flow back to their customers what that inflation was, or they had to take it and basically had terrible profit margins as a result. Now, in the 1970s, 30% of the US stock market was resources. So we had a lot of companies, and same in the corporate credit markets, that they could benefit from inflation and clearly pass it on. Today, there are a lot fewer companies like that. Resource companies are, 3% of the stock market or something. And so you're in a situation where you really have to be looking at, people like retailers have a much harder time. So you want to look at basically how likely do you think the company is, either from an equity or a debt perspective, to be able to handle that higher inflation environment.
What do you think default rates go to in that kind of environment, Karen?
I don't know if I can call a number, but really, I think a lot of the pricing will not necessarily be about defaults. Like a lot of the corporate debt that people own is companies that are not close to default, and you are dealing with how much risk premium you're putting on the volatility of inflation and how likely they are to be able to manage through that situation, not on sort of actual default rates. There's of course a tail that will actually default, but right now a lot of the pricing is basically a shift in the environment, saying it's going to be a harder environment to navigate rather than true default probabilities coming up.